Quantitative easing, or QE, is a monetary policy tool used by central banks to stimulate the economy when traditional methods, like lowering interest rates, are no longer effective. It involves the central bank purchasing large amounts of financial assets, such as government bonds or other securities, to inject money directly into the economy, increase liquidity, and encourage borrowing and investment. Here's how it works. Normally, central banks influence the economy by adjusting short-term interest rates. However, when rates are already near zero, they can't lower them further to stimulate growth. That's when QE comes in. The central bank buys government bonds or other financial assets from banks and financial institutions. This increases the amount of cash in the financial system, making it easier and cheaper for businesses and individuals to borrow. For example, if the Federal Reserve buys $500 billion worth of government bonds, it effectively creates new money, which it uses to pay the bondholders. The banks that sell the bonds now have more cash, which they can lend to businesses or consumers. This lowers long-term interest rates, such as those on mortgages and business loans, making it more affordable to borrow for big purchases or investments. Quantitative easing has several goals. First, it stimulates economic growth by encouraging borrowing and spending. For example, if businesses can borrow money more cheaply, they're more likely to invest in expansion, hire workers, and boost production. Second, QE can raise asset prices, like stocks and real estate, as the increased cash supply flows into the markets. Third, it helps prevent deflation, which occurs when prices fall, reducing economic activity. However, QE has risks and potential downsides. One concern is that it can lead to inflation if too much money is pumped into the economy, reducing the purchasing power of currency. Another is that it can inflate asset bubbles, where prices for stocks or real estate rise too quickly and unsustainably. For example, during QE programs, stock markets often rally as investors seek higher returns, but this can disconnect prices from the underlying value of assets. QE is also criticized for potentially increasing inequality. When asset prices rise, wealthier individuals who hold more stocks and real estate benefit more than those who primarily rely on wages. Additionally, while QE makes borrowing cheaper, it doesn't guarantee that banks will lend or that consumers will spend, potentially limiting its effectiveness. In summary, quantitative easing is a central bank strategy to stimulate the economy by buying financial assets, increasing liquidity, and lowering long-term interest rates. It aims to boost borrowing, spending, and investment during economic slowdowns. While it can be an effective tool, it carries risks such as inflation, asset bubbles, and increased inequality, requiring careful management to balance its benefits and challenges.